McDonald's, Halliburton, Yahoo all reporting earnings today. Joining us right now, Managing Director for S&P Global's Investment Advisory Services, Mike Thompson. Mike, good to see you. Characterize the fourth quarter for us. McDonald's, by the way, beat expectations this morning for the fourth quarter. Earnings of $1.44 a share, $1.44. Stock is probably going to be stronger, although we're looking at some weakness here based on the expectation. But how would you characterize the fourth quarter earnings period as you see it?
At last, we're going into positive territory, both at the top line and the bottom line. Right now, the current expectation is about, 4.5% growth. I would probably argue it's going to come in a little bit stronger than that. Analysts tend to, under-promise, and, hopefully companies tend to over-deliver. The good news here is that earnings growth is starting to catch up with lofty valuations. And couple that with the fact that, the rest of the world is not as strong a investing in place, a source, the merits of which the U.S. looks pretty good right now.
So go through it for us. I know that everybody has questions here, but I just want to point out 4.4% earnings growth. The sectors that lead that: financials expected to see profit growth of 16%, utility 7.5%, materials 7%.
That's right. That's all good. Financials actually historically are, when they lead out first, they tend to be a harbinger of good things to come. Okay, extension of credit, things like that. The one thing that I would point out that's a little bit concerning is that the consumer has been kind of carrying this economy for the last several years, and consumer discretionary numbers are coming in weak for the first time. We actually have negative growth for that quarter. That could be partly just a dynamic of competition within that sector, but that's something we have our eye on.
Go ahead, Mr. Mayor.
I think it's excellent. I mean, the fact is that if we can combine some tax cuts with that, it should have a tremendous impact on the economy this year. The corporate tax cut from 35 to 15, and the president did mention 20 the other day. He said 15 or 20. I hope he sticks with 15.
Well, Paul Ryan and the GOP, they were at 25. They came down to 20%, right?
Yeah, 15 would be unbelievably good. 20 would be terrific also. And I also think I'm one of these people that opts for a pretty quick personal income tax cut to get money into the hands of the middle class. Number one, I think that'll help the economy in general, and number two, it will help the morale of the economy, and it will deliver on his promise to the people in Ohio, Wisconsin, Pennsylvania.
The working man and woman.
If they can see 20% more in that paycheck, that it comes right into their hands, I think we're going to see a real growth in the economy, and we're going to see a change in the approval numbers for Donald Trump.
You agree with that?
No, I think that's absolutely spot on. I mean, the consumer, people have to always remember, it's almost 70% of the U.S. economy. And that's the wealth creation engine. That's what drives our stock valuations. So, we're trading kind of rich right now on a historical basis, but if you start seeing exponentialized, growth of earnings, which all those things that you talked about would actually be catalyst to that. For example, making, I think obviously we did a quick note on how much a reduction in the corporate tax rate would be and how much it would earn to earnings per share for the S&P. But more importantly, I think, in terms of like global investment, it's hard for us now when we take a look at global allocation to see one place in the world which actually has the merits to invest in right now. So there's a lot of tailwinds going on right now, and I think if you capture them right, investors in the U.S., particularly U.S. equity investors, can expect to see your Dow 20,000 without too much fear.
Wow.
Yeah. Michael, we're late in this economic cycle. It's already the third or fourth longest economic cycle on record. This bump in earnings that we're seeing that you're talking about, is that just catching up because the energy sector took a big hit and now the comparisons look better? Or are there real tailwinds that are going to give this expansion and the earnings boom, the earnings boost a second wind?
Yeah, and that's absolutely right. It was a mathematical certainty that all of a sudden, instead of being a drag on earnings, which it has been for the last several quarters, right, energy is going to be a tailwind. However, even if you X out, the energy sector, which is what we like to do when we think it's an anomalic period, we're expecting like 13+% growth next quarter for the S&P. If you take out even the energy sector, you're still talking about still double digits.
Where is it coming from? What's driving it?
Well, it's actually what's being driven. You're going to get a resurgence in materials, okay, as the economy starts to pick up. There is expectations for demand there. The consumer, we're expecting them to actually put in a fairly modest, but albeit respectable show of, growth for the next several quarters. Real estate's going to become expected to become double-digit earnings growth, and technology.
We got to jump, but real quick, did you say profit growth 13%?
That's right. Next
When?
quarter. Next quarter,
in the first quarter.
First quarter, and then the next 3 quarters behind that.
That's big. 13% profit growth first quarter. Thank you, Michael. Good to see you. Michael Thompson joining us, S&P Global.